Happy Friday, everybody. Chris Griffith here from Stable Point Partners, and wanted to share with you, as we try to do every week, our thoughts on the markets and on the world and what that's going to mean for you as clients and investors moving forward. This week, I'm going to bring back my conversation on the two I's with a small change. But first and foremost, I just wanted to say Happy Father's Day out there to all the dads. Happy Father's Day to my dad. And I hope that for those of you that are able to have a phone call or a FaceTime or see fathers in your lives, you have a wonderful weekend. For those that can't, hopefully fond memories of those that we had time with in years past. So joining you here on Friday the 13th here in the morning, the two big I words this week, we're going to continue our conversation on inflation and also start to talk a little bit about Iran and what's starting to happen in the Middle East. So let me start the conversation with inflation. This is probably a bigger, longer lasting conversation that we've been having for some time. But we actually got some really good news about inflation out earlier this week, where we saw the monthly data from April come in just at a 0.1% increase in prices. This is really is well below any of the 73 economists that were polled for their estimates on inflation, and generally a positive news. However, I don't really feel like this takes into consideration the full impact potentially of tariffs, because it's just fairly fresh data, and I think we're going to potentially see that change in the months ahead. So I know the Federal Reserve's looking at that closely, but what does this mean for us? And if we look deeper into the inflation data, I'll share a chart with you, but there's really different sections of our economy that are inflating and deflating at different prices. For example, in April, the biggest area of deflation was actually airplane tickets. Air travel and travel in general outside the United States really cooled off here temporarily. But what we want to look at are core goods, super core services, and housing. And I'm going to share a chart with you that kind of goes back over a decade. And post-COVID, core goods, kind of things we need every day, have come down, obviously first. And you see that real full impact of inflation getting back to normal levels, honestly, late 2021. But what's been really stubborn has been what we call super core services. And these are things more like that you'll use every day, such as haircuts, plumbing, legal services, healthcare, things along that line. These have been slower to come down, but we're starting to see that evidence now here these last few months. And the big change that we're really starting to see is around housing, which you'll see here as the green line. And I'll share another chart with you here as well on housing, what we'll look at as overall rent, or what's called owner's equivalent rent, which is a measurement of what you as a homeowner, if you're a homeowner, would get for rent for your home if you were to be paying rent for yourself. And this has been the most stubborn part of the inflationary adjustment these last couple of years. And you're really starting to see, as we've talked about for a while now, this cool off, and it's leading to lower inflation numbers. So with the lower inflation numbers that we are seeing, most economists, including those that we work very closely with at Goldman Sachs, have started to increase their outlook for interest rate cuts from the Federal Reserve. And they're really starting to see a higher probability now, back end of the year, mid-fall, late fall, into the beginning part of 2026. The potential probably increasing a bit now for the Federal Reserve to start to once again cut interest rates. We think that if that does happen, it'll be slow, 0.25% at a time, and probably like every other meeting, not necessarily every 6 weeks when they do get together. So we are going to be watching the inflation numbers closely, as always, to see how that influences asset prices in your portfolio, spending, budgeting, things of that nature, and how tariffs may potentially impact this over the summer months, and see where we go with those. The other big I word this week is in the Middle East with Iran. This is very new information and something that I'm sure will develop into a better understanding in the days ahead. But with the missile launches from Israel into Iran on Thursday night, we are seeing, as expected, a spike in oil prices, a spike in gold prices, and a little bit of a flight to quality in the financial markets. These are very normal. We've managed money through many Middle Eastern situations, some small, some larger. And obviously the first and foremost thoughts here go out to the people in Israel, the people in Iran, for safety and hopefully a short issue ahead over the coming days. But as an investor, not something you want to make any major changes to in a diversified portfolio. If you have oil and energy stocks, if you have gold or other assets like that, you'll hold up quite well during markets like this. And potentially it's short-lived. It could be a longer event, but more to follow from us as this develops, but certainly something that we're keeping an eye on. Besides the two eyes of the week, this weekend marks the U.S. Open golf tournament, always a favorite with dads on Father's Day to watch the final round of the U.S. Open. So if you're a fan, I hope you enjoy it this weekend. I hope for those of you outside of the Boston area, you get some good summer weather. We're back in our pattern this year of rainy weekends and beautiful midweeks. So with that said, just want to say happy Friday, happy Father's Day weekend to you all out there. Thank you as always for all your trust, your confidence, your advocacy of our practice and what we do. We appreciate it and hope you have a great weekend.